All right, so welcome to today's lesson in Module 2 titled How to Value a Business. Let's take a look at our targets, what we want to accomplish or what we want to be able to do by the end of this lesson. First, I can describe a small business model and utilize the model to determine the value of the business. I can define the components of the accounting equation. I can use the accounting equation to determine the equity of a business. I can calculate book value per share and compare it to market value. I can use earnings, book value, and PE ratio to value a company's stock. Now, some of these terms may look familiar either from our discussions in this class or if you have any other previous finance experience. If you've taken an accounting class, any background knowledge that you have on this will be beneficial. So as usual, take a moment and pause, read over those, and give yourself an honest and private self-assessment of where you're at, where you are at in terms of being able to reach these targets right now. All right, so we're going to start today's lesson examining a small business. And so I would like you to introduce you to Joe. And Joe would like to open up a coffee shop, or Joe owns and runs a coffee shop. It's titled Joe's Coffee. So when analyzing a small business, there's really three components. There's the owner, which is Joe. There is the business, which is the coffee shop. And then there are the customers, which is represented in the bottom left here. Each person plays a role in how we look at a small business or how a small business functions and how we use that to value a business. So we're going to take you through a very, very simple, condensed example, much smaller in scale than if we were looking at a large publicly traded company like Apple or Nike or something like that. So let's say in 1 hour of business at the coffee shop, customers spend $100. And that's not necessarily just one customer. That could be represented by various customers, numerous customers. So the business, in other words, generated $100 in revenue in 1 hour. Now, in order to generate that $100 in revenue, there are costs associated with it. Any business will also have costs associated with generating revenue. Let's say for this example that 20 of those dollars go to help pay the employee or employees. Joe is simply the owner of the business. He is not working there as well. He has his name on it, but he is actually not participating in the daily operations of the business. So $20 are going to go to pay the employees. Another $40 is going to actually pay for the coffee itself. And then we'll say another $10 goes towards the rent and the utilities and the maintenance of the actual building itself. So if I generate $100 of revenue in 1 hour at Joe's Coffee Shop, or if Joe's Coffee Shop generates $100 in revenue in an hour, it costs them $70 to generate that revenue. Again, that is our $20 plus our $40 plus our $10. Okay? Now, what that does is that leaves Joe and Joe's business with $30 of income before taxes. Okay? Now, we'll say that there's going to be $10 in taxes. So that leaves Joe, the business owner, with a net income or earnings of $20. Now, you'll notice that as our $20 in earnings appears, there are two arrows, one pointing to the owner and one pointing back to the business. If Joe decides to pay himself or take that $20 and pay himself, maybe he considers that his income, that's how he makes a living, is on the profits of or the income of the business, that is called a dividend. And so just like if you own shares in a publicly traded company and they pay you a dividend, again, that is a portion of the company's earnings paid to its owners. So any money going to the owners is considered a dividend. Now, you could take some of it and pay yourself. You could take some of it, and the other option is Joe could put money back into the business, called retained earnings or retained equity, as we'll get into a little bit more. And so you could do all one way and all the other way. You could split it. You could say, I'm going to pay myself $10 and then I'm going to put $10 in the business. But regardless, and the reason why we're looking at this is exactly how multi-billion-dollar or trillion-dollar corporations work as well. When there is income, when there is a positive number at the bottom of the income statement, really they have two options. And oftentimes they will do both, as we'll look at as we examine here. Now, I really want to stress the importance of the term earnings, because you're going to see it a lot over the next few slides and in this lesson. And it's going to be one of the really, really important metrics that we use as we start to evaluate stocks. Okay, now, shifting gears just a little bit, you'll see the business is exactly the same. But to make things a little bit more in line with a larger company, all we did was we added a couple of zeros to the numbers. So instead of 100, we're generating 100,000. And so maybe this represents the entire year or a month. And then the 20,000 for employees, 40,000 for the coffee, $10,000 for the rent. So our cost of revenue is now $70,000. So everything else is really the same. We still have income before taxes. We still have to pay taxes, and we still have a net income. And we still have the decision to make of, do I pay myself or do I put money back into the business? So everything else is the same from a process or a model. It's just that the numbers are a little bit bigger. Okay, so here's your question. If you could buy a business that would earn $20,000 a year and you wouldn't need to do anything, what would you be willing to buy it for? Now, we're going to assume that this business has very little risk. It is a stable business. It has been around for a while. They have a consistent customer base or a loyal customer base. So again, pause the video and think about, if you could buy a business that would earn $20,000 a year and didn't have to do anything, you were the owner of the business and they said, here's $20,000 every year, what would you be willing to buy it for? Go ahead and pause the video and think about what that number would be. All right, so let's take a look at and reflect on maybe what some of our thoughts were and what we would pay for that business. So that business would be Joe's Coffee Shop. Again, Joe's Coffee Shop has a net income of $20,000 a year. And if you were the owner of that, that would be your return. They would give you $20,000 a year. So the question comes is, would you pay $400,000 for a $20,000 a year return? Would you pay $200,000? Think about, would you pay $100,000? Okay. The thing that we really have to consider, and this is where we start to draw some comparisons to or between small businesses and publicly traded companies, is the business never changed. Somebody that paid $100,000 to get $20,000 and somebody that paid $400,000 to get $20,000 bought the exact same business. The business is not different if you paid $100,000 versus $400,000. If you bought shares of Apple when 5 years ago, when the price was probably below $100, or today, the business of Apple it's still Apple. Yes, they have different products, and yes, they've obviously adjusted and have certainly adapted their business model a little bit, but the business is still the business. Okay? So if we looked at a percentage return, if you paid $400,000 and got 20%, that's a 5% return. If you paid $200,000, you would get a 10% return. And if you paid $100,000, you would get a 20% return. So think about where your number ended up there. But the lesson here, again, is people, let's say two people bought on either end of the spectrum here. They paid the maximum of $400,000 and they paid the minimum of $100,000. They are both getting the same business, except they are getting different returns. Okay? So this might be a good time to pause, take a quick stretch break, shift gears a little bit, get up and move around, because probably the next few slides might take a little bit longer. So pause the video, take a quick break, and then come on back. Okay, so here we are back again. We have this up here to look at Joe's coffee shop. So this is similar to the previous slide. Again, we have our income, or we have our revenue, we have our cost of revenue, we have our net income before taxes, then we have our taxes, and we have a net income. So we still have our net income or our earnings here of $20,000. Okay. Now, when we start to look at valuing a company or valuing a business, uh, now we have to think about pricing, and we all have to think about what do we think the business is worth, as opposed to letting the market tell us what the business is worth. So let's say Joe wants to sell his business. Now, despite Joe's somewhat confused look on his face, Joe is actually a very successful business owner, and his business has been running and operating very well. But he wants to sell. He wants to get out. He wants to try new ventures. He wants to open up a different business. So he's going to set the market price at $200,000. Okay? Now, if you go back to our slides there where we talk about paying for a business that would pay you $20,000 a year, you would be getting a 10% return on your investment. So that is the market price. That is what he is asking for his business. What we want to think about as investors is we want to think about how safe is that investment. Yes, we see that we are going to get a 10% return and we're going to earn $20,000 a year. But then we have to start to think about, well, what happens if this business fails? And that, unfortunately, is one of the best ways to sit and really evaluate the value of a business. All right, so how do we do that? So really, there's three main components, three main financial statements or financial tools that we'll use when examining businesses to try to determine what we think the value is. And the first one is the income statement. And the income statement, in a very simplified form, is what we just went through. We have income, or we have revenue, and we have expenses, and we have taxes. And at the bottom of the income statement is that net income. Now, for a small business, we would consider that net income. When we get into publicly traded companies, we talk about shares, we start talking about earnings. The second financial tool that we'll use is called the balance sheet. And the balance sheet is a statement that shows the assets and liabilities of the business. So again, as I mentioned in the beginning, if you've taken an accounting class or if you're familiar with any of these terms, the balance sheet portion of this lesson might be a little bit of a review. But that's when we get into calculating equity and book value. And then there's the cash flow statement, which we're not going to get to in this lesson. We'll wait a little bit once we have kind of the fundamentals established here. Okay. So let's take a look at Joe's coffee shop. Right. So there's a lot of stuff on here, but the balance sheet for any business is made up of three components: our assets, our liabilities, and our equity. Okay. So a question that we want to know is what would happen if the business liquidated right now? So if we killed the entire business and turned it into cash, where he is done with it for various reasons, maybe because he just no longer wants the business, or maybe the business is no longer successful. And so we just want the business to end. Okay? What we have to look at is what are the things that the business owns, which are its assets. What are the things that it owes, which are liabilities? And then whatever is left over is what we consider the owner's equity, or the equity in the business. So if Joe wanted to kill his business and turn the entire company into cash right now, on the books, his business would be worth $7,000. Let's take a look briefly at the assets and our liabilities, and this will help clarify some things. Again, our assets are our valuable resources used to run the business. So we have cash not in Joe's bank account, but in the Joe's coffee shop bank account. We have the coffee shop itself. We have a coffee machine. We have some supplies, and we also have some land that has value. Now, you'll see often is that something that is an asset is also considered a liability. So that might cause some initial confusion because, well, how can something be an asset and something be a liability? Well, let's take the coffee shop, for example. The assets represent what the coffee shop is worth on the books. And so Joe probably paid $10,000, or that is the value of the coffee shop currently. Now, the coffee shop was probably purchased with a loan or some type of credit. And so Joe still has $9,000 left to pay on that coffee shop. Same thing with our coffee machine. We have a $5,000 coffee machine, but we still have $3,000 left to pay it off. One of the best ways to understand a balance sheet is for yourself to sit down and think about what are all of the things that you individually own that are yours, that have value, versus any outstanding liabilities that you may have. Now, for a high school student, that's probably, there might not be anything on either side. But if you think about for a family that owns a house and owns a vehicle, that would certainly start to add up in both the assets and the liabilities column. So total assets are $44,000. Total liabilities are $37,000. So if we took all of our assets and sold them, again, that term liquidated, and we turned them into cash, we would still have to pay $37,000 in debts to our credit card, to pay off the loan for the coffee shop, to pay off the loan for the coffee machine, and to pay off the loan for the land. Okay? Whatever's left is what we call our equity, is the difference between the assets and the liabilities. So this represents how much the business is worth on the books. So whenever we're evaluating businesses and we look at, well, how much is the business worth? We have to look at our equity. Some people will look at it and say, well, it's worth whatever their assets are. Well, that's not true, because those assets may not be as valuable because there might be a liability attached to it. So again, this is how much the business is worth on the books. And this is the number that we want to use, the first number that we want to use to look at evaluating a business. Okay. So again, Joe is offering $200,000 for his business. So if I bought the business, or if somebody bought the business for $200,000 and you got a net income, or you got income every year of $20,000, you would be getting a 10% return. But what we also have to think about on the risk side is, what if I buy a business for $200,000 and the business fails? Do I have what we're going to refer to as a margin of safety when it comes to the actual value of the business? And really what the margin of safety is it looks at the difference between what the market price is, or the asking price, and the actual value of the company. So in this case, $7,000 only represents about 3.5% of the market price. So the further these two numbers are apart, the bigger the risk. And so we could think about it like this. Let's say today you wrote a check to Joe for his coffee shop for $200,000, eliminating all of the bureaucratic legalese and things like that. So you wrote him a check for $200,000, and then the next day the business closed, or the business went under, and you had to sell all your assets and you had to sell all of your liabilities. The only thing that you would have left would be that $7,000. So we'll see this not only in small businesses, but as I mentioned, we will also see this as we start purchasing stock in our publicly traded companies. So what we want to look for is, we want to look for investments where these two numbers, our market price, or the price currently being asked in the market, and our equity, are as close as possible. And we'll look at some examples here. Okay. Now, let's say, for example, again, anytime you need a quick break or you need to go back, feel free to pause the video, get up and stretch, anything at all. So again, let's say Joe didn't get any takers for $200,000. So he has lowered the price, and now he is offering $100,000 for his business. And now instead, what he wants to do, right, is he wants to break the company up into multiple shares or multiple pieces in the company. Okay. So instead of one person offering, paying $100,000, he's breaking the company up into 10,000 pieces. That's the term shares outstanding. Outstanding are basically how many shares are being owned by people or by owners of a company. Uh, Large companies, the Apples and Walmarts, there are billions of outstanding shares that are owned by the board of directors, that are owned by some employees, that are owned by average investors like us. But those are the number of shares or the number of pieces of the company that are available. You can think of it's broken up into 10,000 equal pieces. And so we calculate that the market value, now we're operating on a per share basis, is $10. And how do I figure that? Well, I take the $100,000 market price and I divide that by the 10,000 outstanding shares, and I get $10 per share. Now, nothing else has changed in the business. We still have our net income or our earnings of $20,000, and we still have an equity we still have $7,000 in equity for the business. Okay. So again, 10,000 shares outstanding. Now, if we look at the business on a per share basis, and this is really one of the key lessons here, is when we're looking at investments, we want to value a single share of the business the same way that we value the whole business. Okay, I'm going to say that again one time. We're going to value the one share of the business the same way in which we would value the entire business. So if there are 10,000 shares outstanding, and let's say I purchased one share, now my earnings per share is $2. For every share that I own, I get $2. Okay, how do we figure that out? Well, we take our net income or our earnings of $20,000 and we divide that by $10,000. So the earnings per share is $2. So if I bought the entire company, I would get $20,000. If I bought all 10,000 shares, I would get $20,000. If I bought one share, I would get $2. My return on the investment is the same for either one. Now, another term, and when we're talking about companies and we're talking about individual shares, we don't necessarily talk about equity. What we do is we talk about book value. And again, this is on a per share basis. So our book value per share is whatever the value of the company is on the books. Again, that's our $7,000 divided by the 10,000 shares in the company. That gives us a book value of 70 cents per share. Now, if you think about it, Joe is asking for $10 per share, but the company on the books is only worth 70 cents. So going back to that concept or that idea of the margin of safety, how would we feel about a gap in the value of the company on the books versus what we actually paid for in the market? Okay? So again, remember, one share is proportional to the whole business. Okay, so let's look again. Market price is $100,000. There are 10,000 outstanding shares and at $10 a share. And we still have our net incomes or our earnings of $20,000, and the company is still worth $7,000. Okay? There are still 10,000 shares outstanding. Again, one share, if I own one share in the company, I have an earnings of $2 per share, and my book value is 70. So how do we value Joe's Coffee Shop? So as an outside investor or a potential investor, right, how do we value Joe's Coffee Shop? Right. Well, there's two metrics that we're going to use, and these are probably the two most important metrics that investors, at least fundamental investors or investors, which we're trying to do is we're trying to find businesses that are undervalued, is called the price to earnings ratio, or sometimes referred to as the PE ratio. So we need two components to this ratio. We need a price and we need an earnings. Okay. And all we need to do then is we need to take the market price, and we're operating on a per share basis. The market price, again, one share of this company costs $10, divided by the earnings per share, the EPS, which is $2. That gives me a ratio of 5. Now, there's no denomination to that when it's just a ratio. So when we divide dollars by dollars, we just get a number. Here's what this number means. And if you get anything out of this lesson, it's the ability to understand and grasp the importance of this statement. So for every $5 I spend on this stock, in this case, Joe's Coffee Shop, I should receive $1 in profit a year later. So pause the video and think about that statement and the impact that it has, not only on Joe's Coffee Shop, but think about the impact that it could have on buying a publicly traded company. So again, for every $5 I spend on this stock, I should receive $1 in profit a year later. Now, for whatever number this is, or this number changes depending on which company you're investing in, and you're going to have the opportunity to do some research on a couple of different companies. But in this case, for every $5 that I spend, if I were to buy Joe's Coffee Shop, I should receive $1 in profit a year later. All right, so that's the PE ratio. The second one is what we refer to as our price to book ratio. Again, two things. We need a price, and in the price we're referring to the market price versus the book. So what we do to calculate this is we calculate the market price divided by book value. So in this case, the asking price in the market is $10 per share. Our book value, again, which is our outstanding shares divided by our equity, gives us 70 cents. So in this case, the market price is 14 times what the company is worth on the books. We would say that this company is overvalued. Now, most companies that you research, you'll find that they are overvalued in terms of their market price to their book value. Really, it just becomes a question of how big that number is. And going back to that idea of our margin of safety, the wider or the larger the number is, or the larger the number of times the company is worth on the books compared to the market price, the greater risk we have. Because if I buy this company, Joe's Coffee Shop, for $100,000 and that company fails, there is only $7,000 of equity in that business, or the business is only worth $7,000. Okay. All right. So what do we do with all this? What does this mean? So we're going to get some practical exercise in how the professionals value companies. So the first step is to select two companies, preferably in the similar industry. We want to compare apples to apples, not apple to apple, but apples to apples, that you're interested in investing in, not trading. So we're taking that trading hat off for a while, and we're putting our investing hat on. We're putting our long-term goggles on. So you're going to go to Yahoo Finance to research your two companies using the following metrics: earnings per share, our PE ratio, and our price to book. And so if you need a refresher on what exactly those three are, you can go back to the video and rewatch. So once you have done that, you'll go to Google Classroom and you'll see there's a stock valuation assignment. You're going to find the slide with your name on it and create a visual comparison of your two companies. While you're doing this, I want you to think infographic, not presentation. I want you to think that I want this to be visually appealing, not necessarily just a bullet points as if I were doing a presentation. Okay, so Yahoo Finance. If I go to the homepage and I go up here and I type in any company name, it'll take me to this summary page. So I pulled up Johnson & Johnson. And so again, my metrics are, I'm looking at earnings per share, I'm looking at our PE ratio, and then I'm looking at the price to book. Now, the nice thing is that two of these are available to us right here on the summary page. You can see here our PE ratio for Johnson & Johnson is 25.99. So now that number in itself doesn't sound or might not mean much until we actually compare it to another company. So there's our PE ratio. And then there is our earnings per share. In this case, Johnson & Johnson has a $5.68 earnings per share. So for every outstanding share, the owners of this business earned $5.68 or $5.68. Okay, so there's your two. The third one our price to book is going to be under our statistics tab. Okay. And then here we would look at, see what our price to book is. So in this case, Johnson & Johnson is trading at about 6 times what the book value is. And so you can also check to see if that is correct by scrolling down a little bit, and you can see here is the book value per share. In this case, on the books, Johnson & Johnson is worth $23.92 compared to their current market price of about $148. This number might not be exact because we don't know at what time they exactly calculated it, and this price is changing constantly. So it might be off just a tad. Okay? Have fun with this, and try to find, find companies that are in the similar industry, and get creative in how you are going to display this information. Imagine that somebody else was viewing this and they wanted to know which stock to buy. Offer up some visually appealing accessories to your stock analysis.